for Bitcoin to be successful, not only has to be scarce, it's usage as a store of value, as what the things it aims to do, have to stay the same or go up over time. So generally, someone's bullish on Bitcoin, they think, one, it's a good network, it solves a problem, it's scarce, and then two, that I think that's going to continue taking market share, and that say 5 years from now, more people will be holding Bitcoin than they are today. And if that thesis holds, you probably should expect Bitcoin to do well, especially in the face of dollar debasement.
In this recent interview from Less Noise, More Signal, with Lyn Alden, we learn about Bitcoin's role as a hedge against fiscal instability, the increasing focus on debt monetization, and how central banks are handling inflation in today's market. At the time of this discussion, Bitcoin is trading around $67,000 with a 1% decrease in the last 24 hours and a 6% increase over the last 30 days. Lyn explores how Bitcoin offers unique protection amid fiscal challenges, especially as we head toward uncertain economic territory. Before we continue, don't forget to like, subscribe, and share this channel. Now let's hear more from Lyn Alden.
And then same with gold. It's just that, gold is starting from a higher adoption base and does have some mild dilution going on. I think that the productivity growth doesn't really impact the deficits too much. What it affects is how inflationary those deficits are. If you have high deficits, but you have pretty low productivity growth, or even negative productivity growth, then those deficits are more likely to show up in inflation. Like if we're not doing a good job of gathering new energy and increasing our automation and making our supply chains more efficient, then that money supply growth over time is more likely to transfer into goods and services going up in price. On the other hand, if you have pretty significant productivity growth, then at least certain areas won't increase in price as much as you think because it's offsetting the size of the deficits. But then there's the case that inflation is a spectrum. And so, for example, over the past 100 years, waterfront property has been very scarce, followed by fine art and gold, which are pretty scarce. And then there's things like oil, which we have gotten better at finding, but it's still fairly an energy intensive and scarce process. And then you go down to soft agricultural products, grains and soybeans, that we very good at making more of over time. Things like electronics. And so you have this spectrum. And if you're holding things like dollars or treasuries over the long period of time, the things where the productivity growth is coming from are probably not getting more expensive than you. Like $1 can literally buy you more television than it could 20 years ago. For a couple $100, you can get a decent television that's better than the television you could have gotten 20 years ago, because the productivity growth of making televisions has exceeded even the debasement rate of the dollar. Same thing for a lot of electronics and some textiles and things like that. On the other hand, if you were holding gold, then not only did you keep up with that, you can buy multiple TVs for the same amount, the same ounce of gold you could before. And Bitcoin's not been around for 20 years, but basically over time, if Bitcoin is successful at growing in adoption and remaining scarce, then you could buy even more televisions. Basically, you still want to, no matter what productivity growth is relative to the fiscal deficit, the debasement that's happening, you still don't want to hold the denominator that's diluting you. And instead, you want to hold the things that are scarce and attractive and that are at the top in their game, right? So, you want to own the big tech monopoly stocks, whatever the trends, whatever is dominant, you want, and not heavily diluting its shareholders. That's what you want to own, or gold, or Bitcoin, or certain high quality real estate that you can. One of the best things about publicly traded companies and real estate is you can also attach a fiat currency short to it. You can attach a 30-year mortgage. So if the money supply is growing by 7% a year, there are people that took out 3% mortgages, and you're on the right side of that. You're shorting the currency that's getting diluted, and you're buying a house which gets slowly diluted and has maintenance and taxes. You're kind of arbitraging that spread. And the same thing if you buy a blue chip stock. Why? Procter & Gamble's been around for a century. They've been profitable for decades straight. Why do they have debt? They have billions of dollars in debt. And the answer is because they're arbitraging that. They're using that fiat currency short. because they can issue, until recently, they could issue like bonds at 2% yields for 5, 10, 20 years. And they're shorting fiat currency against their more valuable equity and the assets that they own and the cash flows that they can increase prices on over time. And so basically the combination of owning fairly scarce things that maintain market share in their space, and then either having, and then shorting things that are rapidly increasing in supply and therefore not retaining their value. So debt monetization occurs when the central bank and its broader commercial banking system are increasing the money supply to buy and hold a significant portion of government debt. And so if you have debt being issued and it's not being monetized, then you have what is effectively a crowding out effect, which is that, around the margins, it means that, if you're raising your deficits and you're not printing money to do it, then investors are having to absorb more of that issuance, which means they're buying government bonds and then they're not buying something else. Because most entities like asset managers and households are not particularly leveraged. And so when they buy something and they don't buy something else, that's a crowding out effect. That's a choice. And when they do that significantly enough, you get very levered. Like the amount of government debt relative to the size of the monetary base becomes very high. And that hit a peak in 2008, where you had all very high public and private debts on a very thin monetary base. So way more claims for money than there actually are base unlevered dollars. And so their answer was, we'll just create a lot of dollars. And basically that is an anti-deflationary effect, because if you have a big debt, it starts to kind of implode on itself, then you start to get outright deflation pretty quickly, because you're literally when there's something like 50 claims for dollars, total debt, 50 claims for dollars for every $1 in the system. So it's like a game of musical chairs with 50 kids and one chair, and the music stopped, which is calamity, right? So what they do is they start adding more chairs, and they don't have to add 49 more chairs. They just have to have enough chairs being added that it starts kind of slowing down that process, and you get this anti-deflationary force. So basically you get an inflationary force on top of a negative inflation force, and you kind of balance that out. And so and then when you kind of fast forward to COVID, you have very large deficits. You don't really have things like bank failures or debt implosion. And so you just have large deficits going out to people. And instead of taking private sector money and kind of using that to buy the bonds and then redistribute it, it's just a lot of, half of it or so is just being printed. Basically, the central banks just creating new base money and buying it through their intermediaries. And then they're also increasing liquidity of commercial banks that can then go out and buy it. And unlike household entities, they're levered 10 to 1. So when they buy government debt, they're not really crowding out themselves too much, as long as the central bank has provided pretty liquid reserves. And so they can kind of just keep running deficits for a very long period of time and monetizing it. And the cost ends up being inflation, which again is it can show up as literally high inflation, or it's just showing up as inflation that's high relative to a negative baseline if there's a lot of productivity growth happening.
As we've just heard from Lyn Alden on Bitcoin's role in mitigating fiscal instability, let's take a closer look at her insights on debt monetization and inflation. Lyn highlights Bitcoin's unique value as a defense against inflationary pressures, making it an essential asset to consider in today's economic environment. Now let's hear more of her perspective.
Yes, a part of it. There's actually been an interesting series of central bank reports that have mentioned Bitcoin. So the ECB had a report saying that basically if Bitcoin goes up a lot, then it benefits the holders and it punishes the non-holders or the late adopters. But that's true for any asset. I mean, when U.S. tech stocks added 10 trillion in market cap over a decade, you want to be owning those. You didn't want to be the one not owning those. Same thing if Bitcoin goes up at size. So it's they argued before that Bitcoin's done as a bad investment, and then now they're shifting it to, if it's a good investment, then that's also bad because it means that those that don't own it are missing out, and that we should maybe curtail that. We should get all the non-Bitcoiners to help us in our politics against Bitcoiners, essentially. Yeah. And then this other paper basically argued that it's easier to run structurally forever government debts when alternatives are banned or heavily taxed or otherwise impaired, which is true. I mean, basically, when after World War II, I mean, a lot of the ways that governments solved the debt problem is they kind of just did capital controls, they banned gold, they forced entities and individuals to own debt, and then their purchasing power got partially transferred to the government to pay off the debt. And then the way that they can and this is where using debt strategically can be helpful. One of the sneaky things is that like capital gains taxes are not inflation adjusted. So if you buy a house and it goes up by 7% a year, and money supply goes up by 7% per year, and then after 10 years you sell this house as an investment, you don't have to pay it. You might have made no like net growth. Like you didn't really grow relative to the money supply. You just kept up with the money supply. But then now you owe a big chunk of taxes just for kind of keeping up with the money supply. So it's actually similar to by being diluted at the end of the day. And they can do that for gold. They can do that for Bitcoin. They can even target to go after assets higher than normal taxes. So if they particularly don't like an asset because it's like the best one or something like that, it's giving them the most headaches. And so governments do tend to want to add frictions or costs or taxes to try to recoup the fact that some people are trying to escape the debasement. They want to impose debasement because they want to tax, they want to spend more than they tax, because that's popular. But then when there's obvious costs, or some people are better at escaping that than others, they want to try to then close those like exit doors, or offset those exit doors in various ways. And you see also, I mean, emerging markets sometimes do this with dollars. They don't want people owning dollars when they want them to own their own fiat currency, which is debasing even faster. And this is kind of a cycle as old as time, is to try to basically debase the money. It's kind of an invisible inflation tax on the population, and then try to obfuscate or block the exits. And it's funny that the Minneapolis paper just kind of outright mentioned it. It was pretty blunt about it. And there have been other ones. The liquidation of government debt by Carmen Reinhart. It was republished by the IMF, and they're literally just saying that normally you need a captive audience to own the devaluing debt, and they're just saying it. And then they explored like, what if we ban cash? Because if you ban cash, then you could do outright negative interest rates. And the problem is if cash is an option, you can't have like negative 4% interest rates because people would just hold it out in cash. So then they're like, how can we do different schemes to like, this is back during the disinflationary 2010s. They were just kind of like, hey, if we wanted to have super negative interest rates, how can we make it harder for people to escape cash?
To watch the full interview, check the link in the description. Lyn Alden provides a comprehensive look at Bitcoin's potential as a hedge against fiscal challenges and dives deep into key economic trends. We'd love to hear your thoughts. Do you see Bitcoin as an effective inflation hedge? How do you think debt monetization will shape future economic policies? If you enjoyed this discussion, please subscribe, like, and share our video for more content exploring the innovative world of decentralized technologies.